There's one mistake that I see retirees make over and over again, and most of them have no idea they're making it, but it can cost them millions over a 30-year retirement. And the most frustrating part is they're not doing anything reckless. They're actually trying to do the right thing, but they're still ending up in a position that can seriously hurt their retirement. But this mistake is avoidable with just a little bit of foresight. And there's a 3-step strategy that will stop this problem before it happens. And that's what this video is about. So real quick, I'm Justin Haywood. I'm a certified financial planner, and I've helped hundreds of people retire with confidence, and this channel is dedicated to helping you do the same. So the mistake that I see retirees making over and over again is building a portfolio that isn't aligned with how they actually need to use their money in retirement. But that doesn't mean that they don't have a good investment strategy. It's just not the right strategy for their retirement plan. And that's how this mistake goes unnoticed, because it looks like your strategy is working until it's actually time to retire. And there are typically 2 types of investors that I encounter who make this mistake. And if you're watching this video, there's a good chance that you're one of these 2 types. The first type is the do-it-yourselfer. Picture Mark. He's 61 years old and he's built a $2.3 million portfolio almost entirely on his own with S&P 500 index funds and tech-heavy growth positions. And he's a self-directed investor, and honestly, his strategy has worked. He's done exactly what disciplined investors are taught to do. He stayed invested, he stayed patient, and let the market do its thing, and it's paid off really well for him. But here's the problem. What worked perfectly while he was saving becomes more fragile once he starts withdrawing. And Mark doesn't really see that yet. So when I ask him why he's keeping the same allocation going into retirement, I understand his answer. He says, that's what got me here, so why would I change it now? And that's a good question, and it's the response that I hear from most people who are in Mark's shoes, and it makes a lot of sense from his point of view, but there's something that he's not accounting for. After he retires, he plans to withdraw 4% a year, which is about $92,000 per year. And he's assuming that the market will keep performing the way that it has. But what if it doesn't? What if it drops 25 or 30% during his first year of retirement? Suddenly, his $2.3 million plummets to about $1.6 million. And at the same time, he's still pulling out his $92,000 per year. So now Mark isn't just losing to the market, he's withdrawing from a shrinking base. And if you think that can't happen, remember, the NASDAQ dropped about 33% in 2022. And you don't need a single big drop to feel pain. A few 10% drops in a row while taking out withdrawals can result in the same thing. So here's where this gets dangerous. Most people think that if the market drops 30%, it just needs to go back up 30% to recover. But that's not the way that it works. Let's say you have $100. If it goes down to $70, you actually need to make up 43% to get back up to 100 because you're recovering from a smaller number. And for Mark, he's not just fighting the market, he's actually pulling money out at the same time to live. So the year after the drop, he's not withdrawing 4% anymore. He's drawing closer to 6% because $92,000 is a much bigger slice of $1.6 million. And the hole gets deeper and deeper every year the market takes to recover. This is a problem that we call sequence of returns risk, and it's putting Mark's retirement plans in serious jeopardy. Not because he did anything reckless necessarily, but because his portfolio wasn't designed for how he actually needs to use it. And it's not the market that failed Mark. It actually helped him while he was accumulating. It's his plan that failed him. So if there's one lesson that you take away from this video, let it be this. What got you to retirement is not what will get you through retirement. And if you want to know what will get you through it, the 3-step solution is coming up in just a couple of minutes. But first, you need to meet the second type of investor, what I call the cookie cutter. The cookie cutter takes a completely different investment strategy, but ends up in the same position as Mark. Take Susan, for example. She's 64 years old and has about $1.9 million saved and hired a financial advisor to manage her investments. Her advisor put her into a 60-40 portfolio, 60% stocks, 40% bonds. This is the most common default portfolio people get put into. And it seems reasonable on the surface, but there's a little bit of a problem here. Nobody actually asked Susan what she needed from her portfolio, because if they had, they would have found something that shifts the entire conversation. Because in addition to her Social Security, Susan also has a pension. So she only needs about $50,000 a year from her $1.9 million portfolio, which is only about 2.6%. She doesn't need to pull 4% like Mark, and this changes everything. Because a 60-40 portfolio is designed to reduce volatility, smooth out the ride, protect you from big drops. But if she only needs 2 to 3% from her portfolio, she doesn't need as much protection as a 60-40 assumes. She doesn't really need to minimize her risk. In fact, she doesn't really mind the market's ups and downs. She's been investing for 30 years and she knows downturns happen. She just wants to make sure she's covered if things get really bad. So the question isn't, is a 60-40 a good portfolio? The real question is a 60-40 portfolio right for Susan? And the answer is less clear because it depends on her goals. If she wants to leave money to her beneficiaries one day, she may want to get more aggressive to maximize the long-term growth. So Mark and Susan are two different types of investors, but they have the same problem. Their portfolios don't match their evolving needs. So how do you address this problem in your situation? Well, you'll want to follow these 3 steps. And if you take these steps, you'll be ahead of 90% of the people that I talk with every day. Step 1 is to define your income needs. Before you touch your portfolio, answer this question. How much do you actually need from it every year? Not a rough number, the real number, because once you know that, everything else follows. For Mark, $92,000 covers all of his needs, but Susan only needs $50,000 because she has a pension. So you want to find out your number and then move to step 2 to make sure your number will actually hold up. And step 2 is really important. It's the stress test of your plan. What happens if the market drops 30% during your first year of retirement? What happens if inflation stays high for a decade or more? What happens if your spending changes as you age? These questions might seem scary, but the answers are going to tell you exactly how much protection you need and how much growth you can afford to chase. Work through these numbers with your advisor, stress test your plan, and move on to step 3, which is to build the portfolio after the plan. The problem is most people start with an allocation number like 60-40, 70-30, 80-20, whatever feels right. But the allocation should be the end result, not the starting point. Once you know your income needs and you understand your real risk exposure, the right portfolio becomes obvious. Mark needs a buffer that actually fits his lifestyle. So here's what that might look like for Mark. Maybe we set aside 5 years of withdrawals, about $460,000, into short-term, high-quality bonds. That's his protection bucket. If the market drops hard in year 1, he lives off of that. He never has to sell a single share while the market's down. His remaining $1.8 million stays fully invested and primed for growth. That puts him now at roughly an 80-20 allocation instead of 100% stock. He's still growth-oriented, but he just has a buffer that didn't exist before, which makes all the difference. Now, what about Susan? Susan has the opposite problem. She's overprotected for a risk that she doesn't really have. Her protection bucket doesn't have to be as big as Mark's because she has Social Security and a pension. So we run the same process, 5 years of withdrawals set aside, which is $250,000, and that's her protection bucket. And the remaining $1.65 million can remain invested for growth. That puts her closer to an 80-20 or a 90-10 portfolio. Now, if she's not comfortable with that, we can scale that back a little bit, but she does have that ability to take on a little bit more risk if she feels comfortable with it. And over a 30-year retirement, that difference isn't small. It can be worth millions. For some people, the right answer is a conservative portfolio, but for others, it's more aggressive than they ever expected. But it's their answer. It's personalized. It's built for their life, not just some cookie cutter template. Because your portfolio shouldn't reflect your age. It should reflect your full situation. If you'd like to build a portfolio that reflects your life, I'd be happy to help. There's a link in the description where you can go to our website and schedule a call, and we can have a look at your situation and figure out what the right portfolio is for you. We'll map out your income needs, build a withdrawal strategy around those, and construct a portfolio that's built around your life, not just some template. Again, the link's in the description if you'd like to get started. And if you're looking for something else to watch, I've recorded another video right here that you can watch.